G'day guys, welcome back to the Devon Too Good investing channel. In this video today, we're going to be analyzing Alibaba's latest earnings release, and we're going to talk about the good, the average, and the bad from that release. And we're just going to talk about expectations moving forward with Alibaba. So they dropped their earnings on Thursday just before the bell of the US Open. And after releasing their earnings, the stock actually shot up to $93 per share, which represented just over a 13% increase in share price. And we're now sitting at a market cap of $252 billion. So the first thing we're going to talk about, so this is the first good point that I took out of the earnings, was the full year annual active customers. It grew 15.6%. So you can see that from the March quarter of 2021, they had total users of 1.132 billion, and they increased it to 1.309 billion users. So that's a net add over the year of 177 million users. And now in China, they've actually hit over 1 billion active users, which is just crazy. And I'm sure it represents almost everyone who has access to the internet in China. As I think China has a population of, I think it's 1.3 billion or 1.4 billion, somewhere in that range. So they are coming close to saturation there. In terms of their local consumer services, there's definitely room to grow here. And obviously internationally, they also grow their users from 241 million to 305 million. And you can see quarter over quarter, though, the net adds is starting to slow down, and this probably reflects the challenging macro environment that we're seeing at the moment. And most importantly, though, if we look at the year over year, I think the year over year tells the best story. So this sort of user growth indicates that the moat is intact. It shows that people are still active on their e-commerce platforms and that people are still engaged. And if we look at GMV, it only grew 2% year over year. So that's the gross, that's pretty much the total dollar value of all the products bought on the e-commerce platforms. And 2% is actually quite slow. Usually this grows in line with GDP. However, the total, this is pretty much due to macro, as well as slowdown, with the COVID lockdowns and all that. So not much to worry here. Everything looks good in terms of their, engagement on their e-commerce platforms. What was also good was the full year revenue growth. So they actually grew revenue 19% year over year, which is pretty funny considering some of the bearish headlines that we've seen for Alibaba stock over the last year and a half. People have been very bearish on the future of the company and the future of China in general, especially with all the regulations. But obviously the regulations have hurt, especially big tech in China. Think Alibaba, think Tencent, think JD. But look, at the end of the day, the numbers paint the story, and they grew 19% year over year. And what makes matters even better, China commerce, it grew 18%. This is the largest portion of their business. It makes up 69% of total revenue. We saw strong growth in international commerce of 25%. That makes up 7% of their revenue. Local consumer services, this grew 23%. And this actually sped up in the recent quarter as much of China, including Shanghai, went into lockdown. People become more dependent on these consumer services. It made up 5% of the revenue. Cainiao, this is their logistics business. This helps solidify their moat and get e-commerce packages and deliveries out to customers as fast as possible. It is pretty much the best out there in China. It grew 24% year over year. It makes up 5% of revenue. And apart from their Chinese commerce, cloud is their second most important segment of their business. It grew 23% year over year and makes up 9% of revenue. I'm going to be looking for this one to continue strong growth out into the future. 23% is okay. They did lose one major customer which was ByteDance. They're the creators of TikTok, so they're deciding to move away from Alibaba Cloud, and they made up a significant amount of the revenue. So if they did not lose that key customer, this number here would be above 30%. Digital media and entertainment, look, it barely grew 3%, but then again, it only makes up 4% of the business, so you don't want to get too worked up over that. And then innovation initiatives and others, it grew 23%, makes up 1% of the business. So overall, I'd say revenue growth was strong, 19%. It came above sort of my expectations. So yeah, I'm more than happy with this. What was also good was the Q4 revenue growth. While it's not as strong as 19%, in the March quarter, there were some significant headwinds, the COVID lockdowns. That's going to hurt their business. It's going to disrupt people from getting the logistics filled. It's going to stop people from receiving packages because those delivery networks are going to be definitely affected. So 9%, I'm pretty happy about that, and it was driven by Chinese commerce, which was 8% growth year over year. We'll talk about international commerce later because it was something that I was pretty disappointed about. But then local consumer services grew really well, and I think this was related to being locked down, people relying on these services even more. Cainiao, the logistics, 16% year over year growth for the March quarter. That is okay. Cloud, this came in pretty soft. We'll speak about this in a second in the following slide. But overall, I thought it was going to be worse. I'm not going to lie. I thought it was going to be maybe 6-7% total revenue growth for the quarter, but it beat my expectations. And considering the macro factors at the moment affecting this business, I'm not disappointed. I'm pretty happy with this. They were also they showed good capital discipline over this year. So the first point that I want to point out was they reduced their share-based compensation by half. And I'm pretty happy because their earnings went down about half. So, which is obviously really bad, but at least they're not sort of, they're getting paid in line with how the business is performing in terms of earnings. And I think this shows good capital discipline. So instead of, in 2021, they had share-based compensation of 50 billion RMB, and this reduced down to 24 billion RMB in 2022. This shows good integrity from the management. And they also authorized a more aggressive share buyback program. So they are starting to buy shares back more aggressively. They changed it from a $15 billion share buyback program to a $25 billion share buyback program. And honestly, I'd like them to increase this. The shares, in my opinion, are trading dirt cheap compared to the underlying fundamentals of the business and the cash flow that this business will produce moving out over the next 5, 10, 15 years. Alibaba, they're planning layoffs and they're looking to cut more than 15% of their workforce, which ends up being about 39,000 staff. So this doesn't sound good, but the fact that growth is starting to slow down, the macro environment is changing, I think it's good for them to cut back on expenses. This is going to improve their margins and make the business more profitable. Possibly they could cut back on areas of less importance and then focus their efforts more on the areas that really move the needle for this business, such as the China core commerce, the international core commerce, cloud, and then Cainiao, their logistics business. Their balance sheet is very tight. It's a good balance sheet. They got $54 billion of net cash, and at the moment, this actually makes up 21% of their market cap. So if we're looking at this company on a enterprise value kind of basis, it's about 200 billion because they're trading at about 250 billion. So you take the cash away from the market cap and that gets you at 200 billion. So we move on. This is the meh. So they did have soft Q4 cloud growth. It only grew 12%. And the management came up with 3 reasons why. The first one is slowing economic activity. Makes sense. Rising interest rates across the world. Although, to be fair, China, I don't think they're raising interest rates. Someone, if anyone knows, they should just comment, leave a comment. But in terms of slowing economic activities, there are certain industries that got hit. They saw softening demand from customers in the China internet industry, but also in the education industry as well, from the changing regulations there. There's also delays in completing the hybrid cloud projects due to COVID-19. Things tend not to happen as quickly when people work at home in terms of getting projects finalized, getting things signed off and all that sort of thing. And also just people being sick in general. It's going to push back timelines for these projects, but this might just end up being pent-up demand for later. So possibly, we could see a re-acceleration of growth moving forward. And the company on the conference call also reiterated the China cloud market outlook. So this is actually third-party data. This isn't data from the management themselves. They're taking it from a third-party researcher. And this particular research firm believes that the cloud market is going to grow at a CAGR of 37% from 2020. And obviously, that's very, it's very quickly looking at, and it's even quicker than what Alibaba Cloud is sort of growing at now. I think this might be a bit optimistic considering what we're seeing in terms of growth. However, it does show that things should be positive for the China cloud market moving forward. Now, if we look into the bad, so the bad is essentially their earnings. So it's their earnings per share, it's their margins, and their free cash flow. We're going to look at non-GAAP measures. Usually I wouldn't recommend this, but in this quarter particularly, they had a lot of one-off expenses. They had to pay a part of a anti-monopoly fine, I believe. So this affected the earnings, and that is a one-off, it's a one-off expense that will not occur next time. So in this case, non-GAAP earnings is a better representation of their business. And you can see that margins compared to the full year were affected. Their, adjusted EBITDA margin for the 3 months ended March 31st, it was 8%, and it's pretty much, half of what it was for the full year, which was 15%. So these margins are getting squeezed as of late. Year over year, earnings per share fell 19%. And then dilute earnings per share per ADS for the last quarter, it fell 23%. So, it's pretty bad. I can't deny it, but obviously there's macro changes happening, tough operating environment, the one-off fine. It is what it is. We just got to accept it and then, rework it into our valuations to just see where the business is at. Free cash flow. You can see that they generated negative free cash flow for the fourth quarter, minus 15 billion RMB. And for the full year, they were at least free cash flow positive, but it actually dropped 43% year over year. So their net cash provided by operating activities, this was obviously affected by the fine. But they're also increasing their capex as they reinvest into their own business. So the capex expense is growing while, their revenue has been kind of slowing down. The margins have been squeezed. So that means less cash provided by operating activities. So moving forward, I think this number will turn around coming into sort of the next year, next 2 years. It will definitely turn around. I'm quite confident on that. But it is ugly, right? It is still minus 43%. So, it's something to watch moving forward. And it's probably worth adjusting your DCF model for more conservative growth rates if you haven't done that already. I was also disappointed by the international commerce. The year-over-year growth, it was okay, 24%, but they are getting out-hustled by C Limited, because C Limited grew 64% for the year, or at least for their year-over-year March quarter. Lazada, it only grew 32%, which is still fast, but it just shows that they're being outperformed by C Limited at the moment. And it will probably continue moving forward, to be honest. C Limited seems like, or Shopee seems like the clear number one player in Southeast Asia. Lazada seems like a clear number two. And in the previous quarter, the international retail only grew 4%. And this was mainly due to a decrease of revenue of Trendyol that was negatively impacted by the depreciation of the Turkish lira against the renminbi, and a decline in orders of AliExpress, which was due to the ongoing impacts from the change in the European Union's VAT rules, as well as supply chain and logistics disruptions due to the Russia and Ukraine conflict. So overall, it was disappointing. These reasons are valid. Yeah, you can't argue against it, but what you can argue against is the Lazada growth compared to C Limited. C Limited are seeing the same issues that Lazada is seeing, yet they're growing twice as fast. So the management is just executing better at C Limited. However, this isn't the end of the world. Alibaba is a diversified business, and 32% growth is still fast growth. Now, guys, to wrap things up, so the good was that the platform itself is sticky. People are still using it. It grew 15% in terms of annual active customers on their Chinese e-commerce and their international commerce. So you got to be happy about that. What was also good, the revenue growth for the year, 19%, can't be mad. Revenue growth for the quarter, it was 9%, but I expected it to be a lot worse considering the environment that we're in at the moment, and the capital discipline from the management was good. So you got to be happy. Cloud for Q4, it was meh. I thought it would have been a little bit faster growth, but the long-term thesis for the cloud business has not changed in my opinion. I think they've still got a huge runway to run, and Alibaba Cloud is the number one player in China by quite a large margin. And then obviously the bad was the EPS margins and free cash flow. We're going to have to refactor this into our valuation of the business. And then of course the international commerce, not so much for the yearly results, but for the last quarter's results, it was quite soft. It was quite disappointing. But guys, for me, my Alibaba thesis remains the same. I still think it's grossly undervalued. As long as those China risks don't come into play and destroy the business, I think there's big upside here. Overall, the business had a good, I'd say it was a better than expected quarter overall, and probably a better than expected year. So considering what we've been seeing out there in the media. But guys, thanks for watching this video. Make sure you like and subscribe, and I'll see you in the next one.